Any gain recognized must be passed through the mutual fund to the current owners, even if they didn't participate in the gain. You say, well, that's not fair. Well, that's what it's like throwing your lot in with everybody else. Hi friends, Colin Richards here, and we're back in this segment of the Lord and Richard Show to talk about some of the complexities of taxes. The greatest expense you're going to have in your life is taxes, most likely. Now, taxes won't bankrupt you because it's a good sign if you're paying taxes that you're still making money, right? But what we want to do is reduce, mitigate, eliminate taxes whenever possible. Pay your fair share, of course, but don't pay $1 more. And in our last segment, we talked about required minimum distributions and how it's important to begin timing the distributions through a strategy we call a Roth conversion, or moving your money from forever taxed to never again taxed. And so getting ahead of the curve, not waiting until age 73 creeps up on you and suddenly now you are forced to take money out of your IRA at unknown tax rates. So use today's known tax rates. The next area of complexity is how you own your investments. So not just the issue of distributions from those investments, but really the issue of what's going on behind the scenes in those investments and how you own them. The key here is to remember that the tax system that governs non-IRA investments that you have in things like stocks, bonds, and mutual funds is called capital gains. That means you invested capital in a company or through other forms of investment, and that capital appreciated in value. The company that you bought into, be it Apple stock or whatever it is, grew in value. So that's called a capital gain. You increase the value of your capital. If you put in $1, it's worth $2. You now have a capital gain of $1. The IRS is very careful, though, to tell you that there's a difference between capital gains that occur on stocks that you've owned for a longer period, in other words, greater than a year, and that's a long-term capital gain, versus a shorter period, which is called a short-term capital gain. Makes sense so far, right? But here's the key. Short-term capital gains are taxed at ordinary income rates, which for most people are going to be a higher tax rate than the long-term gains in your portfolio. You say, well, how do I make sure I don't pay those? Well, that's rather challenging, okay? Because tax concerns and investment concerns can often butt heads, right? If you're wanting to move assets around in your portfolio or maybe just get some money out to spend, you may well incur a short-term gain and therefore pay ordinary income tax on that gain. You might say, well, is there a way I can pay no gains, right? Well, that would just mean leaving your money forever. The problem is your portfolio may well get out of balance. Consider this example. If you had one stock and one bond and that stock went up faster than the bond, all of a sudden that stock is a much larger percentage of your portfolio. Well, how does risk come into play? Well, that stock may well be a lot riskier than that bond. Not always, but in many cases, that's the case. So it's important to regularly go in and rebalance those investments, and you may well incur gains. You say, can I develop a tax-efficient portfolio where we control that a little bit better? And the answer is yes, you can. And the good news is at Lord & Richards, we specialize in mitigating the taxes in your life and especially in your portfolio. And so that's going to be a good reason to sit down and have a tax clarity visit where we discuss this as part of your retirement freedom plan. Now, if you think of capital gains, you're probably thinking mostly in the low bracket of 15%. That is a long-term bracket. The government incentivizes you to hold on to your investments longer. Stay invested in America or wherever it is that you're investing. Well, you might think that you would only incur that 15%, but the reality is as you move up, as you compound in all your various income sources, you may well find yourself in the 20% bracket. Plus, we have a 3.8% net investment income tax that will get added on that. So 23.8%, the highest long-term capital gain rate. Compare that, though, to 37%, which is the highest short-term capital gain rate, the same as ordinary income, plus your net investment income tax. That's almost double the rate of tax. So we really want to get ahead of this and start developing a plan. Each person's situation is different. Sometimes you're going to need to take money out, but other times you may be able to avoid that. Now, remember that if you're in a Roth IRA, okay, and you've been converting assets out of your IRA into the never taxed category, money you put there, you don't have to worry about all this, right? You're tax free. So really maximizing your tax-free investments is going to help avoid a lot of this. But no matter how hard we try, we're likely to end up with some money that is just non-IRA, ordinary money that's going to fall into the capital gains system. Now, here's the other issue. The people whom you are investing with, are they watching out for this for you? Because you might think, well, I'll just not sell and I won't worry so much about diversification and rebalancing and those things, and I'll just let it grow. I've met people who'll have one stock, say Coca-Cola. They love it. They passed it down through the generations to family after family member, and that's their stock. Well, the problem is, first of all, you have huge risk not being diversified. You're focused on one company and you're betting your life on the management of that company to always act in the best interests of the shareholders. That may or may not happen. But, what about stock that is being managed for you by somebody else? Well, let's say you have a mutual fund. At Lord & Richards, we steer you clear of these to the best of our ability because of all the internal costs that are involved and the inefficiencies, okay? But let's say you got a mutual fund and they bought Apple stock back in 1985, okay? But you didn't buy the mutual fund until 2014 and you held it all the way through 2015. In the middle of 2015, the fund manager decides that Apple isn't a good investment and sells the whole thing. Okay, this is again hypothetical. Any gain recognized must be passed through the mutual fund to the current owners, even if they didn't participate in the gain. You say, well, that's not fair. Well, that's what it's like throwing your lot in with everybody else, is you get to participate in gains that you may never have benefited from. Okay, so let's get ahead of this. Let's start building and designing portfolios that don't just leave you to the whims of fund managers and markets. I'm looking right now at one of our detailed investment reports that we've done for a client, and they had, get this was stuff that their advisor put together, 32 funds, 21 ETFs, and a variety of other things in addition to individual stocks and bonds. The average fund in their portfolio owned over 1,600 securities, and so therefore the portfolio contained over 93,677 stocks and bonds. Now, by the way, there's only 3,600 listed equities in the United States. How did they end up with 93,000? It means that they own, let's say, Microsoft. I'm looking at Microsoft right now in their portfolio, and they owned it about 15 times in 15 different funds. Do you think that creates inefficiencies? The problem is we see this all the time. We see this all the time where because of a lack of real management, your portfolio turns over, creating taxes that you never intended to do. The average fund in this portfolio I just shared with you turned over 87%. Okay, that means 87% of the holdings incurred gains without you ever making a decision. And the reality is that this is very common. Folks, it's urgent that we have a conversation around how you own your investments and whether you're unnecessarily paying not only fees in those investments, which mutual funds often come with those, but also excessive taxes due to turnover and duplication in your portfolio. We're going to need to have a talk, folks. So let's sit down and visit. Have your retirement freedom review. It's at no cost to you, but it'll give you peace of mind and it'll get you on the road to starting to reduce or eliminate taxes. It simply starts with a phone call.